All right, so we're going to start capital gains tax today. That is your topic 7. So just to understand what is happening here, if you go to your handbook, so this is the week that we are not supposed to have classes, but because we are short by 1 week because of how tight this semester is, so because of that we have had to, I can move this a little bit more, I think here, just like this. Okay. Uh, because of the tightness of the semester, what we are doing, when you look back, when you refer back to your handbook, what you're seeing in week 6, there's not supposed to be any class. And this class is supposed to happen next week. But we are just basically, imagine this whole thing is just being pushed forward by 1 week. Okay? So we are bringing it for everything, bringing forward by 1 week. So whatever is supposed to happen in week 7, we'll actually have the week 8 lecture. So next week we'll be doing inheritance tax. So that's what is happening because we are short by 1 week. And your exam week is actually going to be in week 12. In 18th May is already given in your local DUFI calendar. All right, so that's the situation. So if you want to understand what is happening in terms of the sequencing of the classes, that is what is happening. So just follow this. We're shifting the whole thing up by 1 week. Okay, so capital gains tax. Let's look at it. It's quite a big slide, a big PowerPoint. We may not be able to get through everything. And for every topic, let me just reiterate once again, since you have the book, you should read with the Melville, okay? Use the slides as a pointer for what is important and not important. Like for instance, trading losses. You saw that trading losses was treated as not very important, just something you need to understand superficially. So those kinds of guides, that kind of guidance will come from the slides. So what is important, what is not important. But as far as studying is concerned, you see for every question, like the question that Miliko asked yesterday about the relocation also, if you see the information in the Melville is actually more detailed than what you get in the slides. So it's always better to read with the Melville, even though it's an older book, it's last year's book, but that's fine, you just don't take the rates from there. But a lot of the theory and what is deductible and not deductible generally is quite reliable, and even in the older editions of the Melville. So make sure you read with the Melville because then you'll get the full picture. So anyway, so this is the, why is it not going? Oh, okay. Yeah, so these are all the chapters of Melville that involve capital gains tax. Okay, so in fact your questions will not be that big. It'll be, but you have to master all these elements. Okay. Yeah, so be guided by the lectures as to what is the level of detail required. So by capital gains tax, what we look at is we look at chargeable disposals. Disposal means it's not defined here. I think it's defined later. Yeah. Disposal, basically, let me just go forward. What is meant by disposal? So for capital gains tax to be imposed, we need three conditions to be satisfied. There has to be a disposal, a chargeable disposal of a chargeable asset by a chargeable person. Okay, so these are the conditions that we need to have the levy of capital gains tax. And a chargeable person is someone who's resident or ordinarily resident. This is a variation on the residency requirement. So normally in international jurisdictions, in tax matters, residency is taken as, in most countries, the general rule is like if you're staying for more than half a year, then you become resident in that country generally. And then there are variations on that, like ordinarily resident, etc., which takes into account your longer term, like how many days have you stayed here over the last 3 years, and so on and so forth. So that's what it is. So if you are actually, so you can see why the UK is having such a hard time economically, because their tax regime is very cumbersome. So they have capital gains tax on everybody. So anybody living in the UK, if you have properties in Italy or Spain or anywhere else, and you sell those properties and you get a capital gain, you have to pay capital gains tax in the UK. I mean, it has no connection to the UK, but they still want to collect tax. So which is why many people are leaving the UK, especially last year after the new changes in the non-domiciled taxation. So anyway, so this is one problem. This is just a reminder of the real world that tax policy has direct implications for economic growth, right? So if you have very punitive tax policies, eventually you're going to start losing all your productive people. So anyway, so that's what it is. So you have to pay tax on your global income, and you have to pay tax on all your global capital gains, etc. So for corporations, when the corporations pay capital gains tax, we don't call it capital gains tax, we just call it corporation tax. Okay, functionally you could make an argument that it should be defined as the nature of the gain, and so whether it's by a corporation or an individual, it should still be called capital gains tax, if that's what it actually is. So anyway, so it's capital, as I said, chargeable disposal. What is a disposal? Sale or gift of whole or part, any exchange, loss or destruction, okay, anything derived from any capital sum derived from an asset. Then, of course, the only exemption is in the case of death, but there you have inheritance tax. So you can't escape tax. In the UK, you can't escape tax. So many countries don't have this inheritance tax, okay, but the UK has it, so you can't escape. So wherever you go in the UK, you will get taxed. So this is one of the high tax jurisdictions. Anyway, so chargeable assets are generally all capital assets unless they are specifically exempted. Now this again, I keep telling you that, this is exempt assets, right? So for capital gains, so I keep telling you to make short notes for yourself because you don't know what is coming in the exam. So in capital gains, for instance, one of the short notes would be, what are the exempt assets? So in capital gains tax, I mean, pretty much everything is a chargeable asset, except the ones that are exempted by statute. So that becomes one of your short notes. Under capital gains tax, what is the list of exempt assets, right? So you have to make a short note of that and prepare it as your own note, and then just read it a few times. Hopefully you can remember most of it. So that's part of your preparation. So similar things, I mean, just giving an example of capital gains tax, but in pretty much every topic, you will find these kinds of, narrative questions that can be asked on, like what are the deductible expenses for employees, etc., etc. So all kinds of questions. What kind of, what can be deducted for self-employed people, all those kinds of, wherever you see these kind of listing, then badges of trade, the ones that I've specifically called out, like badges of trade, then I've called out, your employed versus self-employed. These are all things where you should prepare short notes for yourself ahead of time, so that when you get a question in the exam, you can just straight away start writing from memory, rather than having to sit there and think about, oh my God, what is that? What do I remember? So you should be prepared for those questions, because the questions are going to be in that format. There'll be like one big chunk of numerical questions, and then there'll be like 3 marks or 4 marks or 5 marks of these kind of narrative questions, like talk about the enterprise investment scheme, like you saw some of the questions, right? Talk about the enterprise investment scheme and this and that. Okay, so so that kind of thing. So you have to be prepared for that. So here you can see what is basically not allowed. So disposals between spouses, actually it's not really exempt. It's actually is taken as no gain or no loss. So if you make a transfer between husband and wife, it is taken as no gain or no loss. What this means, remember, what this means is that here, I think I put the house, this is actually employment, this is 3, where I was explaining all those questions from let's go to CGT. CGT, this is actually chapter 5, husband, wife. I think I put something on husband, wife here somewhere. Okay. So slide 16, okay, so if we have slide 16, and then we can, so we can maybe wrap around this and make it a box. So when you're doing the exam, especially when you're doing every time, capital gains tax, everything, make these kind of boxes with your hand, just like that on the question paper. It doesn't have to be a perfect square, but it's a delimited area. So in capital gains tax, you'll find soon that in the format, there will be multiple transactions given to you. He sold a vase, then they'll give you a trick question like he sold a vintage car. Now you have to remember the vintage car is exempt. Okay, so a vintage car you have to write exempt. So they'll throw in a little trick question like that. They'll put in one of the exempt assets and they'll say that he sold this thing and then it's actually exempt. So they'll give you like 5-6 different transactions that he has done. And so for each of the transactions, you have to calculate the capital gain, and then you'll have to add up all the gains and losses on each of the transactions, and then find the net chargeable gains. So in that, what I'm just saying is, just to make it clear in the exam sheet and the class test also, whenever you're doing a particular calculation, just put it in a box. There's no limit on the number of boxes you can have. It just makes everything very clear. So if we have a case where in the year 2000, so what do we mean by husband-wife, no profit, no loss? What that means is that when the husband, so the husband buys, okay, so let's say the husband buys, okay, I'll just say, instead of writing a big word like husband, I'll just write man buys, okay, man buys, and then in 2000, he buys something for 100,000, okay? And then in 2012, he sells it for 175. Well, the market value is 175 in 2012 when he transfers the asset of the house to his wife, let's say. Okay, so here we don't consider any tax. We don't really levy income tax at this stage, CGT at this stage, because we treat it as a by statute. This is by statute. It's not based on any logic as such, but the statute says that in this case we will not register a gain of 175. Okay, but later on in 2017, when the wife sells, okay, to third party. Let me make that clear. Wife sells to third party. Wife sells to third party. If the wife sells to third party in 2017 for 245, okay, the chargeable gains for the wife will be 145 because we will consider the acquisition cost to be 100 and not, although the wife got it from the husband when the value was 175, but because we did not tax the husband at that time, when he transferred a 175 asset to his wife, we still said, okay, there is no gain of 75. There is actually no gain or no gain, no profit, no loss, because of the rule in the statute. So later on, when the when the wife sells to a third party, that is not the husband, then we treat take the wife's cost to be actually the husband's original cost. Okay, so that is the meaning of husband-wife, no profit, no loss. You can see the lack of consistency here, because generally in the UK. We don't treat, for income tax filing and all that, we don't treat the husband-wife as one unit. We treat them separately. So that's why we say that if you have information in your question about husband and wife and all that, then you have to do that. Don't mix up the calculations, because for income tax, those are treated separately. So everybody has their own allowances and all that. But in the case of capital gains, they are effectively treating the husband-wife team as one unit, because they are treating the transfers within the unit they're disregarding, and they're looking at only transfers outside the unit. But anyway, so that's what it is. So it's not really exempt, but it is just treated as no gain, no loss. PPR, principal private residence. Okay, these will come to this. These are vintage cars. So this one we'll discuss later on detail. Chattel. Chattel is basically tangible, movable property. Tangible means that which you can touch. Okay, so tangible, movable property. I mean, a laptop would be a chattel. Okay, laptop would be considered a chattel because it is, you can touch it and it can be moved, right? So NSCs and premium bonds, these are also by statute. Insurance claims, etc. Individual savings accounts, as you saw from income tax as well, they're also income tax exempt, and winnings in lotteries, pools, betting markets. So betting market, that's why betting is a big business in the UK, because any capital gains you make on that, they are exempt from tax. Okay, so what we have to do, take each item in turn, as I told you. There'll be multiple assets transactions given to you, and then You just calculate the gain loss on each of them and then just add it up. And then you have to deduct the capital losses being brought forward or brought forward from previous years, and then deduct the annual exemption to get the taxable gain. So there is an annual exemption in the case of capital gains tax, and that you can find in your tax tables. So always be familiar with your tax tables. So there is a 3,000 annual exemption. Don't forget about this. So these are the rates that are already given here. You don't have to remember these. Okay, so calculate for each asset disposal, calculate the net gain or loss, then add up all the numbers, and then deduct the capital losses brought forward that take out the annual exemption. Then you'll get the CGT payable at the two rates, which you don't have to remember, lower rate taxpayers and higher rate taxpayers, which is basically, again, now here, what do you mean by lower rate and higher rate? So I drew this diagram again by copying it from your first topic one thing. So here, actually, see, one of the mistakes here is actually, again, this should have been, what we should have here is actually over here, we should write 0 to 37,700, and here we should write 37,700 to 125,140. Okay, well, actually, for capital gains, the 125 doesn't really matter. As long as it's over 37.7, then it becomes 24. So even if we make 500,000 in capital gains, you're still going to pay 24. So there is no third band. There is no third slab in income tax, in capital gains tax, right? So basically what I've done here is I've tried to make it a better representation so you can understand. So when you have taxable income, so if you look at your non-savings income and savings income, we tax at this rate. So we start from here. Okay, so normally we think of it as a cake or slices of a cake. The only problem is we start eating the cake from the top, not from the bottom. But here they start taxing from the bottom. So you have to remember that difference, the mixing up of the kind of metaphors, almost. So we are taxing from the bottom. So NSI, SI, if you have in between this and this, you get 20% tax. But if your dividend income falls within this bracket, then you pay 8.75. This is all given in the tax tables. The only thing that's not given is this kind of linkage, that making it clear that which slab leads to what kind of rate for what kind of income tax, what kind of shall we say, tax. So taxation of dividend income, you have these rates. And in the case of CGT, as I've just shown you, that even greater than 125, it is still 24. It doesn't really change. We only have two rates in CGT. So actually this 24 should not have been written twice, but it should have been merged. The cells should have been merged here, and there should have been 124 for both the cells. But anyway, that's complicated formatting, but I'm just telling you what it should be, because there's only two rates actually. Right, so this is what it means, okay? Higher rate, basic rate, this is lower rate, higher rate, this is what it means. Okay, basic rate. Actually, we should call it basic rate, not lower rate, because that's the terminology that we have been using in the topic one. So we should stick to that terminology. Whenever we are referring to these bands, okay, so these are your tax bands from 0 to 37, 37 to 125, and greater than 125. So 125 to infinity. 125 to infinity is your third band. And so these are your bands or slabs, and these are the upper limits of the bands, okay? So anyway, that's what we have, okay? Now here, this is very important to remember, this kind of pro forma. So you'll see that it refers to follow the pro forma. There is no spreadsheet pro forma in the case of CGT that has been provided, unlike the other pro formas that have been given to you, like capital allowances and those kind of things. Like those, in the case of CGT, we have to use the pro forma from here, okay? They haven't given a pro forma in a spreadsheet, but this is the pro forma that you should remember, and I have also made it easier for you in your notes. If you look at your notes, I've made this. Where is the pro forma? Here, okay. So this one, okay, so you have chargeable gain is net disposal proceeds. I'm going from the bottom actually. I'm going from the bottom here, chargeable gain for each, this is for each asset, okay? And so I'm going with, once you know the framework for each asset, then the rest is quite easy because you know you do each asset individually and then you add up all the profits and losses, then you adjust against carried forward losses from previous years and carried forward capital losses from previous years, and then you take out the annual exemption, and then you have the net chargeable gain. So here you can see that, right, so you can see allowable expenditure. So what was I saying? Yeah, so I'm starting from the bottom. The chargeable gain is equal to net disposal proceeds minus allowable expenditure. And what is net disposal proceeds? It is, well, they haven't defined it like this in the slides, but since I'm using the word net, I can use the word gross to determine to label the earlier stage. So gross disposal proceeds is simply what you get from the sale, okay? And then less allowable selling costs, you'll see what those are. Those are like commissions and advertising costs. So allowable selling costs are essentially, you can think of it this way, that allowable selling costs is any kind of expenditure. So it's like the same concept that we have in business expenditures. What kind of expenditures do we allow in the case of business expense? We allow any kind of expenditure that was wholly and exclusively for the purpose of the trade. Okay, so you can narrow that down in the case of asset sales and capital gains tax. You can think about allowable, selling costs as any kind of cost that was incurred, which was wholly and exclusively for making that sale. So if you have to have, like if you're paying an auctioneer, if you're auctioning a painting, say in Hong Kong is a big auction center. So if you're selling something and you're auctioning a painting, then you have to pay the auctioneer's commission, you have to pay maybe the storage costs and the insurance and all that. That will all be considered as part of the selling cost, because if you did not pay all those fees to the auctioneer, he would not auction your painting, and therefore you could not have sold your painting. So you just think logically as to whether this expenditure was essential for making the sale happen. In that case, it's allowable expenditure. So that's allowable selling costs. Then you have allowable expenditure. What is allowable expenditure? It's cost of acquisition plus incidental cost of acquisition. Now, incidental cost of acquisition is very similar to this one. Okay? It's very similar in idea to the allowable selling costs, except that these costs are being incurred when you sell it. And similarly, there would have been some, essential costs that are incurred when you're buying some asset, like maybe agent's commission and other kinds of, maybe you had to advertise because you wanted to attract the sellers. So you had some advertising costs, maybe some stamp duty and some other local taxes and this and that. So everything that is, unavoidable, anything that is, think about the word unavoidable, anything that is unavoidable in order to acquire the asset, any kind of expense that is unavoidable, you are allowed to include that as incidental costs of acquisition. So it's exactly the same idea as allowable selling costs. Plus any additional capital enhancement expenditure. So if you see here, if you remember, we did that case in the case of, we used the word repair. I mean, they have used the word repairs not in an ideal way, but we talked about a ship which was bought, and the ship was not considered. Law Shipping Company versus CIR. There is a case where the ship was bought, but the ship was not seaworthy. I mean, it was not capable of selling. So it was not usable until some further work was done on the ship in order to make it seaworthy. And that kind of expenditure on that additional work was not, although they called it repairs, it was not allowed as a deductible expense for, on an accrual basis. Why? Because if the capital asset is not usable until you did some additional work on it, then the capital asset is not really ready. And if you're doing some additional work to make it usable, that means that work has to be in the nature of capital expenditure. So that's why it was not allowed. But those capital expenditures on the flip side will be allowed here, okay? Additional capital enhancement expenditure, whether it is necessary to make the asset usable or not, whether it's just an enhancement, you're making, maybe you have a 3-story building and then you're building an additional story after getting permission, you're building maybe a rooftop garden or something like that. Those are all enhancement expenditure which will be allowed to be added on to the cost of the asset. Right, so that's what you have, okay? So what I'm trying to, now what you should do mentally so that you don't forget this framework, okay? You will see many transactions where all of these elements are not present. You'll see many transactions where all you have is this one. You just have the first line and then you have this line, okay? But don't fall into the trap of not thinking about these things. So for every transaction, you should have this standard framework, and you should always splash this framework in your mind, okay, across your mind like this. And so any transaction you should take, disposal proceeds will be given. Then you should mentally write allowable selling costs, and maybe it's not there, so you just write it as 0. And so net disposal will be equal to gross disposal. Then allowable expenditure, this will be given to you. So you'll have this, and so there will be nothing here, but you should mentally write these two lines also and just write them as 0, okay, mentally. Or you can even write it actually in the exam, it'll be more impressive that you are aware of the pro forma. So mentally, I think even if you don't write it in the exam fully, but mentally you should always practice like this, that always give the full pro forma, or mentally think about the full pro forma, and where information is not given on all the elements, you should write them as 0 rather than just completely skipping over the elements. Right, okay, so that gives you the chargeable gain or loss. This pro forma is very important because you should follow this pro forma everywhere. Okay, step 1 and 2, calculate the gain, use the pro forma, market value or actual value. Yeah, okay, so let's talk about, now this I've already discussed, okay. These two I've already discussed, incidental cost, action years, fees. Okay. At this point, you should remember we did a case in order to help your recall across semesters. One of the disturbing things we are seeing is that students are not able to recall things we have taught them in the previous semester. Okay. So now that is a problem. You should be able to recall. We did a case last semester on when we were doing contract law. We did a case on acceptance of offers, and this case was called Payne versus Cave, where the person went to an auction and submitted a bid as one of the bidders, but before the auctioneer's hammer came down, he withdrew his bid. Okay, so it was a case of revocation of offers before acceptance, strictly speaking, acceptance and revocation of offers. So he withdrew his bid before the hammer came down. So in an auction sale, the acceptance is not complete until the hammer comes down. So that was the case of Payne versus Cave. So that'll remind you of auctioneers. So they take a fee. So all that I already mentioned to you. Okay, now market value or actual value, arm's length transactions or assume now. Whether you should use market value or actual value. So when you see any kind of transaction, should you use the market value or the actual value of the transaction? Do you need to find out the market value? So the test there is the test of arm's length. Where is 7 is already the pro forma, right? Yeah, so 8 is this. So it's actually now slide 8. Yeah, arm's length. Do you know what is, have you heard this transaction? Have you heard this expression called arm's length transaction? Have you heard this expression? No. Okay. So that means you're not doing enough reading. As accounting students, have you heard of transfer pricing? Have you heard of transfer pricing? No? Okay. So that means you guys are not doing enough reading. As accounting students, by this time you should have already heard about these expressions. So these are terms used in international taxation. You have transfer pricing. And arm's length transaction simply means that if it's an arm's length transaction, that means it's a transaction between unrelated parties. And you'll see that there is a closely connected terminology that we use in corporate taxation, in corporate law. which is called related party transactions. If you remember your duties of directors, which we covered in the last semester under company law, duties of directors, one of the duties that the directors have is to disclose any conflicts of interest when they are doing related party transactions, etc. Like maybe the director's brother is buying something being sold by the company, so that becomes a potential conflict, so it's a related party transaction, those kind of things. So these two are connected ideas. So arm's length means that these are not between related parties. So the idea is the arm's length means by using an arm's distance, I'm keeping the person away from me, so there's a person is not close to me, he's at arm's length. So the idea is that if you're doing a deal with someone you don't know, okay, you have never met this person, you don't have any connection to them, and then in that case, of course, if I'm selling my house to someone I don't know, some random person, the broker connected me to, the agent, then in that case, why should I sell him the house for a lower than market price, right? Because I don't know the person, so I would like to sell it to him at a market price. So the idea is that if the transaction is happening between unrelated parties, it's an arm's length transaction, then we can just take the actual price in the transaction, because the actual price is likely to reflect the market price. So the focus is always on the market price. The focus is always on the market price. It's just that when you have an arm's length transaction, we can treat the actual price as a good proxy for the market price, because nobody's going to sell something to someone they don't know. There's no connection to them, so they will not sell it to them for less than the true market price, right? So for unrelated parties, we take the actual price. But if I'm selling a house to my sister, now that's not an unrelated party. That's not an arm's length transaction. Okay. So family and business partners, if I'm selling something to my business partner, that's not arm's length. So in that case, we have to take some steps to find out what is the market. So you should at least get this idea in your head. What is meant by an arm's length transaction? This is a term of art in the law, okay, and also required in taxation as well. So arm's length transaction. You should also remember the related party transactions concepts from the director's duties. We already covered it under director's duties in the previous semester. So a related party transaction. Yeah, so I did that. Okay, so what are we doing here? Okay, right. So remember this rule, okay? Okay, now let's look at this. So here's a case. Have done the solution here. Okay, so let's look at the information. Bought it for 15. Legal costs of 0.5. Enhancement of 2. And this is your what I'm calling the gross disposal proceeds. The 28K is the gross disposal proceeds, and 700 or 0.7, since I'm using 1,000 as a unit, 0.7 is the incidental selling costs. So you see that happening here. So you see 28K minus 0.7, 28 minus 0.7. You see that? 28 minus 0.7. This gives you the net disposal proceeds less 15 acquisition costs, incidental costs, enhancement expenditure, 2 plus 3, that's 5. So this is the total acquisition cost. This is actually, there's one term that is missing from here. That's why I wrote it here. What I have written here, you should follow this format, okay? In your head also mentally while learning, you should follow this format, then you're likely to make fewer mistakes. So I've got a term for every part of it, okay? So there is chargeable gain is net disposal proceeds minus allowable expenditure. You'll find here that certain things are not labeled, but here we have everything labeled. There is the expression here is the sum total of all this, and this. The sum total of all this is to be called allowable expenditure, and that is equal to cost plus acquisition costs plus incidental acquisition costs, which is the mirror image of the allowable selling costs, and then any capital enhancement expenditure. All those three together become allowable expenditure. So here you can see that in the slide, the allowable expenditure figure becomes 20.5. And so therefore your chargeable gain is 6.8. So it's fairly straightforward, pretty logical. There's no real illogical transaction or steps happening here. So you just have to remember to do this for every asset. And then you have the annual exemption of 3,000. You don't have to remember it because it's in the tax tables. All these rates are also in the tax tables. What you need to remember is that if nothing is mentioned, then you assume that the person is a higher rate payer. That means you have to use 24%. Okay, the note you don't have to worry about because we don't have to worry about what happened last year. So there is a change. Last year we used to have 4 rates. Now we only 2 rates. So that doesn't matter for you. You're only concerned with what is happening this year. Okay. If you have net losses for the year, then your assessment, just like we had in property income, if you have net losses, we show the figure as the income as nil, and then we make a note of the losses and we carry it forward. So if you have any losses, you can't limit the loss deduction to a level where you just come up to 3,000 profit and then you take the 3,000 profit and offset it with the annual exemption. You can't do that. So if a loss is occurring in the current year, any loss occurring in the current year has to be basically debited in full. So you can't basically carry forward in that way. Yeah, and then you can use, when you're using brought forward losses, then you can use them you can use them partially and bring the total gain down to the annual exemption. And you can carry forward this thing indefinitely. Okay, so this is the overall pro forma. This first line comes from doing that individual asset pro forma for every asset that is mentioned, and then you add up all the net chargeable gains figure, or chargeable gains figure for each asset, and you get this one. You get this one, then you take out the capital losses, then you take out the annual exemption, and then you get the taxable gains. So here again, you can, these are basically expressions of what we call the Westminster principle that I discussed with you earlier, that tax avoidance is legal. So in many cases in the UK tax code, you can see them allowing you, just like they allow you to take the personal allowance against, you're allowed to use the personal allowance again in a way that minimizes your tax liability. So sometimes when you have, there was a question earlier on one of the examples of statutory redundancy pay, and that question, it basically they had taken normally we take the personal allowance against the non-savings income, but in that case they had taken it against the SRP. But that was to minimize the tax liability. You don't really have to do that. You don't have to worry about it. But I'm just telling you, there are provisions in the UK tax code that are supportive of the Westminster principle, allowing you to minimize your tax liability by doing clever tax planning. So here you can take it off against gains that will be taxed at the highest rate. Gains which qualify for BADR, we'll come to this. There is a type of relief called business asset disposal relief, and this has a rate of, if you get any kind of capital gains which falls under the BADR category, so there will be some definitions and you have to see whether those tests are satisfied, and if they are, then they can be classified as BADR assets. Then in that case the capital gain on those assets will be taxed at 14%. So it's giving some relief to businesses. Right. So there are two situations. If your taxable income exceeds the basic rate band threshold, then, well, actually, it's not really threshold, it's upper limit. Okay, so I remember I told you there's a difference between threshold and upper limit. This is a matter of English, but you also need to, as you prepare for your exam, you also need to learn how to write proper English, exactly correct English. Threshold actually means the beginning of a particular region, right? So if you're standing just outside, you're standing on the threshold of the class. Not perhaps the best example, but it's correct. Okay, so threshold actually here, the threshold of the basic rate of tax is actually 0. When you're at 0, you're on the threshold. As soon as you cross 0, you're already in this band. This is actually the upper limit. It's not really the threshold. It's the upper limit. This one is also the upper limit. The threshold for the higher rate tax is actually just over 37.7. As soon as you go over that, you get into the second band. So you need to remember how to use the language properly. If you say basic rate tax slab, upper limit, higher rate tax slab, upper limit, that is the correct terminology. That makes it very clear as to what you're referring to. Anyway, the point is this, that if the guy goes outside the, if the taxable income goes beyond the basic rate, band, let's just call it the basic rate band. Once it goes over that, if again is not qualifying for BADR, then you'll have to tax it at 24%. That's the whole meaning of what I told you here. The moment your taxable income goes above this, then you get taxed at 24% on your CGT, right? Now here there is something odd that you need to remember, which is not in the tax tables, that if your taxable income is less than, the upper limit of the basic rate band, then you can't start taxing, the capital gains at 18% right after the taxable income is, covered, because capital gains is taxed last. So first you have, NSI, then you tax SI, then you tax dividend income, then you have capital gains tax. Okay, so capital gains tax is taxed last. So they call it the top slice, because it's like top slice again has the image of a cake, but we are actually, the problem with that image of the cake is we don't eat the cake from the bottom, but here actually they're eating the cake from the bottom, and that top slice means that it's taken last. But in fact, when we eat the cake, we eat the top slice first. So anyway, so you have to remember that problem with that imagery that they have used. Okay, so the point I'm trying to mention here is that, see, if you have taxable income of 25, okay, and let's say you have BADR of 7, what they're trying to say here is that this is the odd rule that you need to remember in case you get a question like this, that if the taxable income is less than the upper limit of the BRT slab, then BRT is basic rate tax. And in that case, you basically, and let's say you have, let's take this example and explain this rule. So you've got 15 of CGT, let's say, and you have 25 of taxable income. Other than that, you have NSI, SI, DI is 25. And so you're well under the 37.7, and then you have 7 of gains which qualify for BADR. So the point that they're trying to make is that in such a situation when this 25 TI is less than this one, then whatever balance remains between 37.7 and 25, you can't put your 15 CGT into that and get it taxed at 18%. No. In that case, you have to put the BADR gains first and get it taxed at 14%. Okay, so this will obviously be 14%. Because it's a standard rate for BADR. It doesn't matter where you are. If it's a BADR gain, it doesn't matter which slab you're in. If it's a BADR gain, then it will be taxed at 14%. Now, what they're trying to tell you here is that you have to do it this way. And what is this 32? Okay, so we have a 5-minute break. This 32 is actually just sum of these two.
class, Chair.
Okay,
So-
let's do it after the class.
Okay.
Because we have only a 5-minute break. Only 5-minute break. Yeah. Let's discuss it after the class.
I forgot to pause the recording, so we have 5 minutes of extra recording. Okay. All right, so let's continue here. I was trying to show you what they mean by that last sentence, in case you get a situation where this happens, where the taxable income is still falling well inside the BRT slab. In that case, what you have to do is, like, here's an example of that. Your taxable income in NSI, SIDI is 25, and your BADR, BADR gains are 7, and you have 15 of CGT, which is not falling under BADR. That is, it is of this type. Gains which do not qualify for BADR are 15. Okay, in that case, after taxing this one at 20%, of course, this one you'll get 20% on that. Okay, this one will be 20% because that's the rate. Okay, for inside the first slab, that will be 20%. Now, after that, you can't take this 15% of CGT and apply it here and get the benefit of most of the 15 being at the 18% rate. No. What you have to do is then immediately after that, you have to apply the BADR gains. So the BADR gains will get taxed at 14%, but the impact of that is, this is the cumulative income. If you take this as the cumulative income chargeable to tax, that I told you to maintain this kind of a running total column, which was very helpful for you to understand when you're moving from one band into the next. And so this is actually the cumulative total of income being charged to tax. And so here this will become like this. Okay, so the meaning of having adding the 7 of BADR immediately after the taxable income in such a situation is that now, after adjusting the BADR and taxing it at 14%, your figure for the total running total of cumulative income charged to tax becomes 32. It's no longer just 25. The problem here now, therefore, is the implication of that is you don't get as much of a relief on the 15 of CGT as you would have if this rule had not been there. And so now you've already taxed 32. So now all you can get for your 15 out of your 15 of CGT gains, gains not qualifying, capital gains not qualifying for BADR is 15. And so out of that, you're already at 32. So you can basically get the benefit of the 18% rate on only 5.7. What is 5.7? Actually, I should write it as 32. No, I should write it as 37.7. This one is 37.7 minus this one. Okay, so 37.7 is the upper point. So it is 5.7, only 5.7 you pay, on that you pay 18%, and then on the balance of this capital gain, which is not qualifying for BADR, this 9.3 comes from the 15 minus the 5.7. So the part of the non-BADR capital gains that remain to be taxed is 9.3. So here you can see your total here. If you add this here, your total chargeable income is this one. At this point it is 32. At this point it is 32 plus this. And at this it is actually this plus this, and then you'll see that it comes to the same number of 47. Okay, so or we can make this one so these two are the same, right? Total income and then total income that has been charged to tax. So that's all that it meant by that last line. So perhaps we spent too much time on that, but since it's mentioned there, I have to explain it. And we already saw the last two lines also, what happens, okay? Now about the gift aid and personal pension contributions. Now you have to remember, I have given a correction actually. In your topic 1 notes, you will see a correction, which is that earlier I had been given some different guidance. Now I think that guidance is incorrect. So actually I have corrected that guidance in the case of your personal savings allowance also. If you remember this one, your personal savings allowance actually is based on taxable income. So it's based on the taxable income calculation. And earlier I had written in your notes, this is actually not clarified in the slides anywhere. And the Melville is also not very clear on this. So it's a bit of a gray area, but earlier I had written that in case you have gift aid and personal pension contribution. So what happens is, when you have gift aid and personal pension, if I make this a little bit less, maybe I make it 85%. Yeah, if I make it 85%, see, here if you have, see, normally our upper limits are 30, this and this, okay? But if we have a gift aid, let's say we have gift aid or personal pension of 1,200, that has to be grossed up, and the grossed up number becomes 1,500. And then we have to add these to this upper limits, and then the upper limits become this and this, all right? Now the question is that now you know that you have to compare taxable income. You have to compare taxable income to ordinarily to these levels. Now the question becomes, if you have a situation like this, and actually these numbers get transformed into these numbers, then should you compare the taxable income level with, maybe I can reduce this a little bit. Yeah. Now, should I compare the taxable income level with this number or with this number as an example, or this number or this number? Should I compare it to the extended upper limits or the standard upper limits? So I think the correct guidance on that will be that, I'm pretty much sure about this now, that the correct guidance will be that you have to compare it to the extended upper limits, okay? Because that is the effective, those are the effective upper limits for that particular taxpayer, because he has made those gift aid or pension contributions. So that's the impact. So remember that although we are studying capital gains tax, because I'm changing some of the guidance, so I'm going back to also going back to, it's exactly the same rule now which will apply for both, we'll both apply this both for capital gains and for your personal savings allowance, okay? Remember that personal savings allowance is determined by looking at taxable income and comparing it to the adjusted BRT, adjusted upper limits, okay? So this is basic BRT SUL means basic rate of tax slab upper limit, a higher rate of tax slab upper limit, and the third one is the additional rate of tax slab. Right, so it has to be compared to this. So similarly here, as you can see from just explaining the case of capital gains, remember capital gains is also determined by what? It is determined by this. It is determined by comparing taxable income, and if you have taxable income that goes into the second slab, then you get taxed at 24%, right? Second or third slab, you get taxed at 24%. So the question is, what happens when the bands are extended because of gift aid contributions? Well, in that case, your slabs are also bigger. So you have to compare the taxable income to the extended upper limits in order to determine whether capital gains tax is to be paid at 18% or 24%. Is this clear? Yeah? That's why that is a meaning of the statement here. And you'll see there's a problem in the Melville as well, where they have mentioned, so typically in a question, if they mention that there is no gift aid or pension contribution in a capital gains tax question, what that means is that they're telling you that the band is not getting extended. The upper limits are actually the same. So you have to compare taxable income only to these numbers. But also what that is also telling you by omission is that in case there are pension contributions, personal pensions or gift aid, in that case the bands will be extended, and the taxable income then should be compared to the extended upper limits in order to determine whether capital gains is to be paid at 24% or is to be taxed at 24% or 18%. Is my point clear? Yeah? You understood what I'm saying? Okay, let's move on quickly. We are already only at 14, where we have so many. Okay, payment of CGT. Okay, there is a typo in this slide 15. So I've made a note here. That's why the notes are also important. So when you're studying, you should actually try to create your own notes, as I said, because you have to create short notes. Actually, you have to do more preparation than what I'm able to show you here in the class, because I'm also not able to prepare everything. So ideally what you have to do is you have to make your own notes. You should look at these notes as well, because there are many important observations in these online notes which are prepared for you. And then you should look at the slides to understand what is important. And then you should look at the Melville textbook as well, because that gives you the full version of the theory. And ideally, you don't need to do that. Actually, you don't need to bother with that. But we have done it for the case of earnings and we have done it for the case of salaries and bonuses in employment income. We went into Section 18(1) of the Income Tax Earnings and Pension Act. Actually, that is the foolproof way to study the law, even tax law. And you can see tax is a very good example of the merger of law and finance. If you take taxes, or you can take tax as accounting, since you're doing it under an accounting program. So tax is basically a merger of finance, law, and accounting all together. Okay, which is why I've always kept telling you that these things are all the same subject, actually. All right, so now there's an error here. Okay, slide 15. There's an error, so I made an error. Yeah, I made a typo here. Okay, this one, the rule for the payment of capital gains tax. Again, remember, this is one of those questions which might come 2 marks or 1 mark or something like that. So what is the date of payment of the income of capital gains tax? So the rule is 31st January. It's not after the tax year. It's actually, to be more clear, 31st January after the end of the tax year. So for ours 25-26, the date of payment will be this one. The date of payment will be 31st January after the end of the tax year, because the tax year is running from, in 25-26, it will run from 6th of April 25 to 5th of April 26. So after 5th of April 26, the next 31st January is 31st January 27. Okay, so this is the one. It is not this 26. So there's a typo here. Okay. Now there is one little caveat. Okay, there's one important caveat about UK property. So this might be a 2-mark question actually then in the exam, that because there are 2 important points, or it can even be a 3-mark question, because you have to remember that there is a separate rule for UK residential properties sales, capital gains realized on sales of UK residential property, and you have to know what the deadline for paying and reporting that income is. So there could be 3 marks on this question potentially, as I see it. So first 1 mark will be for what is the date of payment for non-residential property related capital gains, and that answer will be 31st January 2027. You are only going to be asked about the tax year 25-26. That's one. The second is, there is a caveat actually. Now here, have you heard this expression? Do you know this Latin expression called nota bene, which is shown as NB? Have you seen this before? NB. NB means that it's just like watch out. NB just means like please take note, watch out. So this is something where they will write something, and so this is a good example of using the word expression NB. So we generally say that for non-residential property related capital gains, the date of reporting the income and the deadline for reporting the income and payment of tax is 31st January after the end of the tax year. All right. So for us, it is 31st January 2027 for this year, the one we are considering for the exam. But it's better for you to remember the general rule in case they ask you about some other year. Now, but there is a but. Okay, so NB usually means also something like a but. Okay, watch out, but there's something else, and that is that if you have any kind of UK residential property related gains, that you can't wait till 31st January 31st January after the end of the tax year. You have to report that and pay tax on that within 60 days after completing the transaction. Okay, completing the transaction, I presume they would mean, I haven't read the actual legislation here, but I presume it would mean executing the transaction. Okay, that is the transfer of the title deed and all that. So there is that process has to be gone through. If you remember from your contract law classes, we had studied the important features of contracts, forms of contract. One of the things we studied, forms of contract. And one of the things we said is that certain transactions require certain specific types of forms. They need to be in certain forms. So, for instance, sales of immovable property in most countries will require that there is some kind of an agreement to sell first, and then there is also a transfer of property, a transfer of the ownership in the property. That will be done through a title deed. That has to be done to a deed because the government generally wants to keep track of who is the registered owner of this piece of land or building or whatever, so that we know who to tax for the property tax and things like that, or generally just to keep track of who is the correct owner of this particular asset. So remember this caveat so that's why I gave this as an NB. NB means the 60 days rule for property disposal. So slide 15, it is mentioned there, so you need to know. Not just paid, but also reported. Okay, so it's also reporting and paying. So I'll just clarify that. Report and pay. All right, okay, so we're done with slide 15. Special rules. Yeah, we already covered the husband-wife part. It also applies to civil partners. Yeah, we already explained this thing to you, so I don't have to cover this again. This husband-wife transaction, what is the base cost is basically the original cost of the asset by the first spouse. We already covered that. If it's a jointly owned asset, then took the gain and split it between the couple. Transfer assets to maximize the use of these things. Okay, you can do that. All right. Okay, rebasing. This is just a rule. This is a case of what we call inflation indexing, right? Otherwise, what happens is a lot of the time you'll see that property. This usually happens in most countries. When property prices are going up a lot, it is usually also accompanied by, especially in countries, you'll notice this in countries which have closed capital accounts. In countries which have closed capital accounts, that is, the currency is not freely convertible, in those types of economies, you'll notice that usually when property prices are going up quite dramatically, you will find that there's also a decent amount of inflation. So, and to some extent, the increase in property prices is reflecting the increase in inflation. So, in order to protect taxpayers, so if property prices keep going up, you're going to have high nominal gains, right? And then on that, you'll have to pay high rates of tax. So, what they're trying to do is they're trying to help out the taxpayers so that they don't get penalized by high inflation. So, they have this concept of rebasing. So they're saying that if you held something, let's say you bought something maybe in 1945 or something like that, and it's still with you, and so what they're saying is that we're not going to take the cost from and eventually if you sell it, maybe you sell it in 2025 or something, and then they'll say that, well, we're not going to take the cost because of the cost in 1945 would be much lower than what it was in 1982. So what they will say is that our cost or market value at that time, and in that case they will say that, okay, we want to give you the benefit of this inflation indexing, so we will not consider the cost to be what it was in 1945 when you bought it, but we'll assume that you bought it at the value value it had in 1982. So 31st March 1982 is where we have taken the basing date. Okay, so anything before that, anything bought before that, so they might tell you that here's an example. Okay, so he bought something in 81, April 81. It's quite close to 82 actually, but he bought it in 2000 and he sold it in 26. He bought it in 81, he sold it in 26. On 31st March, it was worth 4.2, all right? So since he sold from 9.5, now you might ordinarily think that the gain here is 9.5 minus 2, but actually this is getting covered by the rule of rebasing, so it won't be 9.5. minus 2, it won't be this, but we are rebasing it to 4.2 because that's what is given as the value on 31st March 1982. So there is a rebasing to 31st March 1982 which you have to be aware of. Okay, now here's another subtopic, part disposals. I have tried to give you some guidance here in the notes as to where certain things start. Part disposal starts from slide 19. I don't know if all the numbers are still correct, but anyway, let's look at it. So slide 19, we start part disposal in case you want to jump to that part quickly. So part disposal is, if you buy an asset, remember that under the way that we have defined disposals for capital gains tax, part disposal is also considered a disposal. So the question is, when you have a part disposal, you haven't sold the whole asset. So what you get for selling part of the asset, that is very clear. The gross disposal proceeds, that number is quite clear. But what is not really clear is what should be the acquisition cost for the part of the bill, a part of the asset that you sold, right? So here there is a rule where it's based on the market values of what you sold and what remains, and so that's given as A and B. Okay, so we have to take the market values. We can't go by like the size of a plot of land, or we can't go by whatever was take a size and look at the original cost. We can't do any of that. We have to go by the market value. We have to go by this formula. So cost into this allowable expenditure, well, strictly speaking, this is going to be the acquisition cost, okay, which is the acquisition cost part of the allowable expenditure. And so that's this into A by A plus B. And A is the part you sold and B is what remains. Let's look at an example. Yeah, so always use the value, not other information like 5 acres of land or anything like that. Like you see here, this example, 5 acres of land. So here what happens is you buy some land, that is 20 acres, you buy it for 150, then you get some special planning permission, and you get you then develop some building over there, and then you sell that site which you develop for 100. So you sold 5 acres, and the remaining 5 is worth 5 per acre. So if it is 5 per acre, 15 into 5 is 75, right? So what you can see straight away is that here the B part in that formula we had, the B is the value of what remains. The B part here is 15 into 5, right? And the A part is this one, 100, because A is what you sold it for, the value you got when you sold it. That's A is 100. And so A is 100 and B is 75. And what is the original cost? That was 150, right? So what will be the total of the allowable expenditure here, or the acquisition cost part of it? That will be 150. Okay, this is the full capital gain, and this is the allowable expenditure or acquisition cost part of it. So it'll be 150, which is the cost, times A is 100, is what you got, divided by 100 plus 75. So you can see here, it's you see the answer is total gain is 14,286, and we have done it in your spreadsheet. Slide 21. Yeah, slide 21 is here. Here you can see slide 21, which is this is your original cost. Okay, cost. This is your A, this is your A, and this is your B, right? And so if you look at this A by A plus B, that comes out to be 57%. This is your A by A plus B, as you can see. This by this plus this, okay? That's 57, and then you take 57% of the original acquisition cost, and so then you get an acquisition cost which is 14,286, which is sorry, not the acquisition cost is not 42, that is the capital gain. This is the acquisition cost, which is the 57% of the, so this is the expression cost into A by A plus B. That expression is 57 point, that expression is giving you 85.7, and so you're ending up with CG of 14.3. Is this clear? Part disposal, so make sure you practice all these formulae, because when you get you will definitely get exam questions like this. So capital gains, I think this year capital gains will be a compulsory subject, and capital gains is actually quite compared to some of the other topics, capital gains is actually quite straightforward. Okay. Here you see he bought something for 26. Sells 1 quarter for 12. He has this of 500 of this 0.5. Remaining is 40K. So we have to first figure out the allowable acquisition cost number, which is going to be cost into A by A plus B. So what is the A? The A is 12K. Right? The so in this case we don't take 12 minus 0.5. We take it as 12K. And then we have 12. Then we have A is 12. And what is B? B is 40. And the cost is 26. So the acquisition cost number will be 26 into A by A plus B. So 12 into 12 divided by 12 plus 40. And then after that you will deduct the, or before that you will deduct the incidental selling cost, but you will figure out, first you have to figure out the allowable, the acquisition cost number for the part disposal. So you got 12,000, you got this. Okay, now what is the acquisition cost here? And that is 12,000, which is yeah, so this 26,000 is the cost, and this is the A, and this is the A plus B. That gives you 6,000. And so this you enter over here, and in the pro forma you put the gross proceeds, incidental selling costs, and that gives you the net disposal proceeds is 11.5. And that gives you a chargeable gain of 5.5. Okay, chattels and wasted assets. So we already discussed chattels as movable property, and not a building and not shares. So shares are not considered chattel, because shares are considered to be intangible, because these days nobody has physical share certificates, and even when you had physical share certificates, the kind of the set of interests represented by a share are things like voting rights and rights to the residual earnings of the firm. So all these are kind of intangible. These are anything like rights and stuff like that is actually intangible. So that's nearly not considered part of chattels, because they're not tangible. So some types of chattels are, so please remember to read this carefully from the Melville. You'll get more information. So more detail is given in the Melville, so I just refer you to that, since we have a lot of material to cover here. So I'll just make sure that you read it from the Melville, okay? we can actually maybe look at chattels, but there are so many chapters in this. Let me see if I have any. Chattels, okay, 19 and 282. I think here I'd like to go to the Melville. 282 means actually 298. Let's go to chattels and just try to quickly go through here. Yeah, you see, a wasting asset is basically, it's not very well defined here. Okay, so you can see always a better definition in the textbook. Useful and not exceeding 50 years. Then you can have a wasting chattel. So first you have a chattel and you have a wasting asset. Okay, so those which are both chattels and wasting assets. This is like your A intersection B kind of idea in set theory, where that will be referred to as a wasting chattel. So let's look at the chattel exemption. Okay, so we will come to this 6,000 rule. Is exempt disposal of anything for 6,000 of chattel for 6,000 or less is exempt. Okay. There are some further clarifications on this. All this stuff is put into a table. So we'll study all this in the form of a table. Cars are always exempt. Okay, now let's look at this 6,000 rule. This also you should learn this table, because again you will get questions. So now we already know that capital gains is a compulsory question. It's most likely to be a compulsory question in the exam, in the final exam. And all of these types of questions are likely to come, which is there'll be one question on this kind of case, or maybe one or two, or technically you can have 4 questions on this, but usually they'll ask maybe 1 or 2. And so you have to learn how to use this matrix. So all you have here is basically you got a cost by sales proceed matrix. So on the left hand side you have sales proceed, and on the upper, in the rows you have the sales proceeds, and this label ideally would be somewhere here on the left. These are the sales proceed, this one and this one, and then this one is cost for these 2 columns. So in the columns you have costs, acquisition cost, and the if you wanted to talk about if you want to use the same terminology that we have used in the pro forma, ideally what we should have written here is cost of acquisition or acquisition cost, and what we should have written here is gross disposal proceeds. So remember here you can see the language here. There you see. Can't exceed 5 by 3. Okay. All this stuff is all referring to gross disposal proceeds. So don't make that mistake. You notice in the previous example, what was I saying? Yeah. If you remember here, don't make the mistake of this one here. Okay. So don't take this figure as 11.5. This has to be taken as 12, because 12 is the gross disposal proceed, because the idea is always to capture. We are using a market value based metric to do the cost allocation for a part disposal of a property. So the whole thing is not being disposed. We don't want to use like size or anything. We just want to use market value ratios. So that's why we always take the gross disposal proceed, not the net. Okay. Right, chargeable, okay, so this one, so let's understand this rule quickly, okay, let's understand this rule quickly, okay, so you got this, the acquisition cost and the gross disposal proceeds. So if you have, this can be either 6K or less, or more than 6K, this one also can be 6K or less and more than 6K. So if you have the first quadrant, if you're in the first quadrant where you bought something for less than 6 or less, and you sold it for 6 or less, that's fully exempt. Okay, so the first quadrant is quite easy. Well, the first diagonal is quite easy. There's a diagonal here which is quite easy, which is this one is quite clear, is fully exempt, and this one, if you look at this one, where the cost is more than 6, and the sale proceeds are also the GDP, that is a gross disposal proceeds, I'll just call it GDP. So GDP is also more than 6. In that case, you have a normal CGD calculation. So like, if you have sold something for 15 and you bought it for maybe 60, in this case you would have a loss of 45. Okay, so, or if you bought it for 15 and you sold it for 60, you have a gain of 45. So this is also, these two are very clear. Okay, the diagonal is clear. Then now we have, let's look at this one. What if you bought it for more than 6, but you actually ended up selling it at 6 or less? Okay, so in that case, there's a special rule that applies. So now we are getting into the more complicated rules. So in this one and this one, in the second and third quadrants, we have some complications. So the second quadrant is, if you did this, it cost more than 6 but sold for less than 6. Okay, what's happening is we are going to allow the loss. We're going to allow the loss, but we will, in allowing the loss, we will consider the sales proceeds to be 6,000 and not what you actually sold it for. Is this clear? So here we have the concept of deemed proceeds. So you have to use this language in the exam. Deemed proceed, I mentioned this to you earlier as a legal term. Deemed means that something is not actually true, but we are assuming that it is true. So usually it is done by a statute or something like that, where you have, in this case, as you can see, the deemed proceeds of 6,000. It's also done by statute. So if you sell it for less than, maybe you sold it for 2,000, but we are still going to assume you sold it for 6,000. So that's it, basically. Then you'll be allowed to have the loss. Maybe you bought it for 9,500 and you sold it for 3,000, but we'll ignore the 3,000 because it's below 6,000, and we'll take the sale as 6,000. So you sold it for you bought it for 9.5 and you sold it for 6, so you lose 3.5K. Right. Then the last one is the most complicated rule of all, actually, which is that if you have something you bought for 6 or less and then you sold it for more than 6, in that case you have to take, now here the labeling is not proper. This is A, normal calculation is A, and this one when it starts with 5 by 3 is B. Okay, so you take A and B and then you take the lower of A and B. So what is A? A is quite simple. A is just a normal calculation. So find out what is the GDP, and then from there you deduct the AC. AC is acquisition cost. We can write smaller, don't talk in the class, okay? I can hear this constant murmur of people chatting with each other. It's very disturbing because I have to constantly monitor what I'm saying to you. So we have to have pin drop silence in the class when the class is going on. You must not talk between yourselves, even in a whisper, because I can pick up the sound. So so we are now looking at this one. So the last one is, so let's look at an example, then you will understand. So this one is not properly labeled on the slide, so please remember this. It's the tax on the lower of, this is A is the normal calculation like here. B is 5 by 3 into GDP. I'm calling this GDP, okay? GDP has a different meaning, of course. It's gross domestic product, but we are going to call it gross disposal proceeds, okay? We are going to call it, because we want some shorthand, I can't keep saying this gross disposal proceed every time. So we will have some shorthands, and capital gains tax is GDP. And we'll call this like ASC, okay? And then this we can call AE and all that. This one we can call C, well, I don't know if we could call it COQ. We can call it COQ, I guess. All these kind of acronyms we are going to use. So this is normal, and this is 5 by 3 times GDP minus 6,000. So if you look at an example here, let's look at an example. Here, he's selling a picture for 6.6. So immediately you know that if he sold it for 6.6, the GDP is covered in the rows of the table. So if you sold it for 6.6 means it's over 6K, so it goes in the second row. Now which column? He bought it for 3.2, so he bought it for 3.2 means first column. So less than 6. Less than equal to 6. So in this case, we do two calculations, right? We first find out, okay, he bought it for 3.2 and he sold for 6.6, so the normal gain is 3.4. But then we have to apply this is just the A calculation, the normal gain. Then we have to do the B calculation. The B calculation is 5 by 3 into GDP minus 6,000. Okay, so GDP here is 6.6 minus 6,000. 600 into 5 by 3, that gives you 1,000. So instead of a chargeable gain of 3.4, we will consider a chargeable gain of only 1,000. And we'll take the lower of the two, obviously. So this is how this thing is done. Here's an example again. In this case, you bought it for more than 6. So if you bought it for more than 6, that means you go into the right column, okay? And you go into the right column, and then you sold it for 5.6. If you sold it for 5.6 means you sold it for below 6,000, right? So in this case, what happens? You are in the first row. So you're on the second column in the first row, which means you're in the second quadrant where we have the rule of deemed proceeds. So we understand that you sold it for 5.6, but because you bought it for more than 6K, so we are going to assume that your sale proceed is actually 6, not 5.6. We disregard what you actually paid. We have a deemed selling price or deemed gross disposal proceeds. And so you can see that 250 is ALC. And so you can see the example here. What will be the allowable loss? We'll allow a loss in these cases, but it is kind of less than what you would have under the normal method because, okay, we got a 5-minute break. All right, let's resume now. Settle down, please, everyone. Okay. Let's look at, where are we here? Okay. So we have this concept of deemed proceeds. Remember, we discussed the idea of deemed. Deemed is a very important legal concept which you need to be aware of. We had already discussed it in the previous semester. So here you have the idea of deemed proceeds. So in the exam, if you get a question like this, you have to use the expression deemed proceeds, right? So in this case, you'll have a situation where he sold it, he bought it for more than 6K, but he sold it for 6K or less. That will be a case of deemed proceeds, especially when it's less than 6K. It will nevertheless be considered as having been sold at 6K. Deeming provision means if something is deemed to be true, that means it's not actually true, but we assume that it's going to be true, usually by statute or some other rule, but it's going to be assumed to be true even though it's not actually true. Right, so this one is there. Okay, so here we have some examples of 4 paintings, okay, which he had acquired. Okay. So first one, cost is 2,000. So if it's 2,000 cost, that means it's falling in the 2,000 cost is falling into the first column. Less than 6K or less, cost of COA, and GDP is 7. So COA and GDP is 7 means it's falling in the second row, first column, second row. That means the 5/3 rule will apply. So we have to take this 5/3 calculation. So let's look at the first calculation here. 7 and 2, 5/3. Okay, so first we have to calculate the 5/3 means that we have to take 2 numbers, the normal profit calculation, the normal capital gain calculation, the normal, shall we say, chargeable gain calculation, and then we have, that's your A, and then we have to compare it to B, which is your 5/3 rule, right? So the first we take the normal calculation, which is the A, and that becomes the GDP is 7,000, and the deemed proceeds, well, we don't have deemed proceeds here, but the cost in this case is 2,000. So the normal calculation of profit is 5,000. That's 5,000, that's your A. But then you have to also compare it to B, and what is the B? The B is basically your GDP minus 6,000 into 5/3. So GDP is 7, and 6 is your, basically by statute, by this rule. So that's 1,000 into 5/3, which is 1667. And so that's less than the 5, so you have to take the lower of A or B. So therefore, you have to take B. So that's why this 1.7 has been highlighted here. Okay, so that's painting number 1. Painting number 2 is you bought it for 8, COA is more than 6K, so that it goes in the second column. And GDP is less than 6, so it goes in the first row. So second column, first row means it's a case of deemed proceeds. Deemed proceeds will happen here in the second transaction. So bought it for 8K and sold for 4.5K. So this becomes a deemed proceeds case, like you can see here. Cost of COA is 8,000, but although you actually sold it at 4.5K, because it is falling under that second quadrant, falling into that second quadrant, so the rule will apply, the rule of deemed proceeds will apply, and so we will assume that the proceeds are going to are 6,000, irrespective of what you actually sold it for. So the deemed proceeds will override the actual proceeds, unless the actual proceeds are exactly 6,000. Even then it falls into the second quadrant, but then we still call it deemed proceeds, but in this case the deemed proceeds is equal to the actual proceeds. It's a special case where the proceeds are exactly 6,000. So anyway, so we take the assumption of 6,000, and then from there we deduct the 8,000, the COA, and we get a loss of 2,000. So that's your chargeable gain, negative chargeable gain for that asset. Then the third one is, well, it's actually not here, it's up here. The third one is you bought it for 3K, which is, that means the cost is, if you bought it for 3K, that means the cost is 6K or less. Okay, so this stays in this first column. And then you your GDP is 5.5, which is more than 5.5 is still less than 6K. So you bought it for 6. So it says first column, first row. First column, first row means it's in the first quadrant, and if you remember, first quadrant is fully exempt. So you'll see here that it is, the third one is fully exempt. Painting number 3 is exempt. So the third one which we look, so right, both is fully under. Yeah. So then we look at the last painting, which is okay. What is the last painting? The last painting is you COA is 7, and so say your COA is 7 means it's greater than 6, so it goes into the second column, and GDP is 9.5, which means it goes into the second row, which 9.5 is more than 6, so it goes in the second row. So second column, second row means it's in the fourth quadrant, and there we have a simple rule, which is this normal CGT calculation. So we'll just take the GDP of 9.5, and from there we'll deduct the 7,000 cost, and that will give us 2.5. That's your chargeable gain for this asset. So please remember to memorize, to understand and practice this table. If you do a few sums like that, you're definitely going to get a question on this in the exam. Okay, assets with negligible value. Okay, now here again, this is the importance of referring to the Melville textbook. Okay, the information given here is not exactly correct. Okay, so there is a concept of assets with negligible value. If something has become negligible, then the owner of the asset can make this kind of a claim, negligible value claim. So you bought something for a very high price. Now it has become negligible, like maybe you bought some kind of penny stock or something, and the company is now being delisted, and so the company shares have fallen sharply in value. So you can make a negligible value claim, and if they accept it, if HMRC accepts it, then you can be, TA is taken as, okay, if it had been not for 0, but for the negligible value that you are claiming. So, and then it will trigger an allowable loss, but there's more to the story. So let's look at the example of 276. There's a 2-page offset, okay? It's 276 means 278 for Melville. So let's look at 278. 278 for us will be actually 288 and 294, okay? So let's look at 294. That the one? Yeah. Assets with negligible value, so let's just look at this one. Okay, so you look at this example here. Let me make it a little smaller so that it fits in one view, and I hope everybody can see it. Yeah. So what happens is, so this part is clear in the slides, okay? You can make a negligible value claim, and if HMRC accepts it, the asset is assumed to have been, so it's not, this is not really true, okay? This information, that's why I tell you that now that you have the book, you must study with the book, okay? A lot of the doubts will get cleared up if you read the textbook. Melville will give you a lot of the theory, which is not really changing from year to year. And so if you accept it, then it's not that it's just sold, it's actually sold and reacquired. There is a notional sale and repurchase transaction that is done. It's notional. It's not an actual transaction, but we assume that there has been a sale at 0, at the negligible value claim, and then the price, and then the asset has been reacquired immediately at that negligible value claim. So that will become the next benchmark for that will become the next cost of acquisition for the next transaction. So that's what you look at an example here. So Gloria acquires 1,000 shares for 7,000. Okay, so £7 per share. £7 means UK shares are quoted at in pence, so 700 pence. So she bought it for 700 pence, but the trading is getting suspended. Trading in the shares is suspended, and then she makes a negligible value claim of 10 pence. So she's saying that something I bought for 700 pence is now only worth 10 pence. Okay, the claim is accepted. So the loss is actually, how much is the loss? The loss is 7,000 minus, and she's got 1,000 shares at 10 pence. So it's basically 10,000 pence, okay, which means there's 100 pounds. So she bought it for 7,000 pounds or 100 pounds. So she gets a loss of 6.9. So she can generate a loss of 6.9. All right. So she gets a allowable loss of 6.9. Now the problem is that if she, remember that there's actually no sale happening here. There is no sale. It's just that notionally we have just done a kind of revalued that share at 10 pence, which you bought for 700 pence, and we are taking kind of like a lower of cost or market, and the market value is 10 pence. So we are taking the book value is 7,000. Now it's actually being taken down to 5,000, to 7,000. Now it's taken down to 100, and so you're getting this loss of 6,900. So you can take that loss and take the advantage of the loss. But what that means is in future, because remember you haven't sold the shares. So in future, if you sell the shares, what will happen is that we will take your cost of acquisition as 100. So let's assume that later on the share recovers, it gets relisted, and then eventually she can sell the shares for maybe 9,000. Okay, she sells it for 9,000. Then we'll take the GDP to be 9,000, and the AOC, that is, or COA, that is the cost of acquisition, will be taken not as 7,000 but as 100. So now she'll have to pay tax on 9,000 minus 100. So that's what is the idea with respect to assets with negligible value. Very important example of why you should always read the textbook. When you're studying the topic, go with the textbook as well. Go with the slides, go with the notes that I've given you, the online notes and the spreadsheet calculations and everything, and then all the worked examples, and most importantly the theory from the textbook. Okay, right, what do we have here? This one, 30 is done, so 31. Right, shares and securities, all right? Some exempt securities, listed government securities. Corporate bonds and ISAs. Okay. Now, how do we do the identification of shares? So this also you're likely to get questions on this. So, as we already mentioned earlier, that if it's an arm's length transaction, and that means the parties are not connected to each other, then we just look at the actual disposal proceeds, GDP number, and we assume that to be equal to the market price, or just a very good proxy for the market price, because unconnected parties have no incentive to do transactions with, they don't have any incentive to do transactions at prices which are more favorable than the market, because I don't know the person, so why should I give him a very good deal? I will just charge him the market price. But if it's connected, if it's friends and family, especially family and business partners, then we have to find out what the market value. So in a question like this, if there is such a problem, they will usually ask you, they will usually give you some information about, they say that he sold the house to his brother for maybe 10 million or something, but actually the value of the house was 55 million at that time, the market value. So they'll give you some kind of clue like that, all right? And sometimes the clue that is given is for shares, okay, for valuation of quoted shares. And so if there is a transaction between related parties, you have to use the market value. And so they will refer to the share price quote. So the share price quote is like this. Okay, so they will usually quote it in pence, as I said. So there'll be a share price quote at 230 plus 230 to 270. What does that mean? This is basically what I've tried to do here. This is slide number 40, I think. Okay, now in this case the slide number has to be changed. We have to take this, and we should actually put this into a box as well. So it won't be slide number 40. We should make it like here, and let's make it as a okay. So there's a box there. Now this one is actually not slide 40. It's actually let's call it slide 33, and let's call it slide 33. So what is let's call it slide 33. Okay, so what is happening here is, okay, now here you need to understand a little bit quickly, although it's not really part of your syllabus, but it's important for you to understand these things. So if you see a quote, share price quote like 230, 270, what that means is this is like the bid and the offer. So you need to know about what is called the bid and the offer, or the bid and the offer is also called the ask price, right? So here you have, let's say if you go to ICBC and you you go and look at their foreign exchange rate board, you will find something like this. So they will quote maybe 6.83, 6.86. So they are quoting the dollar RMB at this rate, 6.83, 6.86. That means that you can, so the bid and the offer, the bid is actually the price at which, now you have to understand something here. In this case, when you go to the ICBC, and do a foreign exchange transaction, ICBC is considered the market maker because they're making this kind of bid and offer prices. These are called two-way prices. They're making two-way prices. They're called the market maker, and you are the price taker. And the bid and the offer, this is the price at which the market maker buys the base currency. Here the base currency is USD, and this is the price at which the market maker sells the base currency, right? So in this case, when you have a quote like 683, 686, this means number of CNY per $1. This is the market convention, okay? You can also quote it the other way, but that's not conventional. So typically in the market, you have to follow the default convention. So 683, 686 is bid and offer, and all they're asking you, and you as a price taker, you have to deal on the market maker's price. So if you want to sell dollars, if you come back from your foreign holiday and you want to sell dollars, ICBC will buy your dollars at 6.83, okay? Now, if you're going on holiday, before going on holiday, when you want to buy dollars and you're going on holiday, you go to ICBC to buy your dollars. At that time, they won't sell it to you for 683. They'll sell it to you for 686, right? So when you go to buy dollars, they will charge a higher price. But when you try to sell them dollars, they'll give you a lower price. That's how they make money. So you have to deal on their prices. Now, all they're telling you to do here is to take the mid price. This is called the mid price, okay, 6.84. How do I get the 6.84? We have followed the complicated method given in the slide, which is they have called it the half up method, so that you take the lower price and then to that you add half of the distance between these two. Okay, half of the distance between this one and this one, and that gives you the mid price. And so when you have to use market value anywhere, you have to use the mid price. They will give you bid and offer prices, but you have to calculate the mid price and use it. Is that clear? You can also get the same result by just taking the bid and offer and just averaging it. But you can just use the method here. Better to use the method given here. Okay, just call it the half up method. And so you figure out the price here is 250. Okay, so that's the case of market value determination when So remember that if they give you bid and offer prices, you can't use the bid or the offer. You have to figure out the mid price. They want to see if you know how to do the half up method for figuring out the mid price. Now, identification of shares. This is important. Again, the same thing that you were doing in the case of part disposal of property. When you were doing part disposal of property, you sold like a part A, but the part B was still remaining. So how do we know what is the how much attribution, how much of acquisition cost has to be attributed for that part that you sold in order to figure out your profit? So therefore we had that rule of A by A plus B. Now here we have a more complicated set of rules for shares. So what we do is we first find out if you sell some shares, and obviously then you realize some gain. We are assuming you start with a long position, you buy some shares, and then you sell some shares. So we have to find out now. Then we need, if you sell, let's say 5,000 shares, how are we going to find out the acquisition cost of those 5,000 shares? So the rule is basically to proceed in this manner. First, find out, did you buy any such shares in the same class? Did you buy any such shares in the same class on the same day, okay, as the date of the disposal? First, look at that. Second, look at the next 30 days. The next 30 days, did you buy any such shares of the same class? Then we use that. We will allocate, against that pool, that block. And then we have the share pool, which is called the Section 104 holding. Once again, we can go back to our Melville textbook because there's a lot of important information there. Shares is 298. 298 means it's 304 and 314. So we don't go to 314, we go to 316 or something. There you are, Section 104 holding. Okay, let me see here. Okay, let's go this share matching rules. Okay, so you see the more detailed rules given here. Okay, let's use that and let's look at this. And now we'll do an example, and then you see that the last point of reference is to the share pool, which is called the Section 104 holding. This is the part of the shares historically acquired which have not been adjusted against any sale. So we'll look at this example. Now, before that, we just look at class of shares. Have you heard of different, now that's why I've given you a note in your files, okay, in class of shares, slide number 34. On slide number 34, I've given you a note here. There you go, share classes, okay. Have you heard this expression, share classes? Do you know about share classes? Different classes of equity shares. So there is this concept now. Do you know that, do you know which is the largest IPO so far in the world? Do you know this figure? It's a Chinese company. Do you know which company did the largest IPO in terms of fundraising? Does anybody know? Okay, so this is Alibaba, which raised $26 billion, likely over $26 billion on the NYSE. So that is still the largest IPO so far. Or maybe it has been exceeded by Saudi Aramco after that. I'm not exactly sure. We can find out. But Alibaba is one of the bigger IPOs. For many years, it was the biggest IPO ever. So now, one of the reasons is, now, do you know why Alibaba chose to list on the New York Stock Exchange and not in Hong Kong? Does anybody know that? Why did Alibaba choose to go all the way to the New York Stock Exchange and not list in Hong Kong? They could have raised that money in Hong Kong as well. So why did they do that? Do you know? Because in Hong Kong at that time, so there is this you have to understand the concept of share classes. So what you have now is you have within equity shares, normally we have thought about equity shares as one share, one vote, right? As you know, one of the distinctive features of equity shares, as opposed to say preference shares, is that equity shares carry voting rights, right? That's how you control the use of the assets of the company, right? You have voting rights. You can vote for this director. You can say, okay, Elon Musk should not be the CEO of SpaceX, right? So you can do all these things at the AGM. You can go to the AGM and you can vote. So what does an equity share give you? It gives you voting rights along with other rights. So normally you have one share, one vote, but in the case of different share classes which companies have created, now you have the concept of super shares. So how do people like Mark Zuckerberg and all maintain control of Facebook or Meta? They don't have a majority shareholding anymore, okay, in terms of plain equity shares. But they hold what they are called super shares, okay? So instead of one share, one vote, your super shares have like one share, maybe 25 million votes. So by holding only a few super shares, he can control the majority of the voting rights. He doesn't hold the majority of the equity shares, but he controls the majority of the voting rights. This is the case with Zuckerberg and Meta and most other founders of tech companies. They have these super shares and they use those super shares to have even a minority shareholding of equity shares, but they have a majority of the voting rights. So that's the idea of the super shares. And so these come from special share classes which carry these differential voting rights. So this is the reason why Jack Ma and the other founders, this is the reason they went to the NYSE, because at that time in Hong Kong, they did not have this provision of share classes. They only had one type of share, which is one share, one vote. And so if they listed in Hong Kong, then all these founders would have lost control of Alibaba, right? So that's why they went to the New York Stock Exchange, which allowed them to have share classes. Now later, of course, Hong Kong and Singapore have changed their rules because they were losing business. Now they're allowing these kind of share classes. But at that time they did not. So that's what share classes means. So I just thought I'll tell you this story since we are in China. So it's a Chinese company, so it's important for you to know these things. All right, quickly let's go and do an example. Okay, example 1 on page 297. That means it's 299. Okay, so 299. Let's look at the share example. Okay, so remember the rules here. First, when you sell the shares, first look at how am I going to adjust these shares sold? How do I take the cost basis for the shares sold? I have to find out some shares which I bought, and I have to apply the cost of those shares which I bought as the COA for the calculation of chargeable gain on the shares which I've sold, right? So how do we do that? First we look at anything bought on the same day, anything bought in the next 30 days, and then we go against this, allocate against the section 104 holding, okay, which is the pool of shares which you have remaining in the company, which was bought before the date of the disposal, but which have not been matched against any other disposal. Let's look at the example here. Okay, let's look at the example. So this guy does all these transactions on these different dates. All right, so he has this. So let's look at a disposal, because when you have a disposal, then you have the requirement to find some shares which you had bought previously, or in this case sometimes up to 30 days later. So when you have a sale of shares, we have a requirement to find some bought shares which you can use, the cost of which you can use to find out the attributed cost of acquisition for the shares that you have sold. So this guy is selling some shares for the first time on 17th May. He's selling some shares. How many? He sold 800. Now we first apply the first rule. Did he buy any shares on the same day? Yeah. We find that he bought some shares on 500, or 500 shares on the same day. So straight away we can take the cost of 500 out of the 800 shares. We can take as whatever the cost at which whatever the price was at which he bought this 500 shares on the same day. That's one. We still have to take care of 300 shares. Now, did he buy anything in the next 30 days? Yes. 17th May to 9th June is within 30 days. He bought something on 9th June, and he bought 200 shares on 9th June. So we still needed to take care of 300 shares. Now we've taken care of 200 out of that, right? So now we've got Now we've got only 100 shares to take care of, right? So here everybody can see, Brooklyn, you can see the whole thing, right? I'm standing here because actually there's so much light here. Everything is like reflecting into my eyes. I can't even see clearly. Especially when I go to this side, I can't see clearly. So I've got to stand here, but everybody can see everything, right? Yeah, because I'm worried that I'm blocking the view here. So anyway, so we got only 100 shares to take care of, and for that we are going to the Section 104 holding, okay, which is shares bought before and not adjusted yet. So let's look at the next one. So 100 will be formed. Okay, so how many did we have before this? So we sold something on 17th May. So before that we bought 3,000. So the number of shares in the Section 104 holding is 3,000. You see? So after that, you have only 100 shares further to adjust. So you adjust that against the 104 holding, and then or we call it the share pool. And so then you have no more shares to adjust, but your share pool has gone down to 2.9. From 3, you took out 0.1, so it's now down to 2.9. Right, so that's one. Now let's look at another disposal here. Any other disposals that are happening here? There you go. There's another disposal happening on 13th March. He's selling 2,000 shares on 13th March, okay? So first find out, did he buy any shares on 13th March? No. Okay. Did he buy any shares in the next 30 days? Yes. So within the next 30 days, he's buying 1,750 shares. So we can straight away adjust this cost of the 1,750 against the disposal proceeds here. So how many do we have left now? We have 250 left to deal with. Okay, so we can now go down here, okay, and see the treatment. Okay, so we sold 2,000 shares, which we have to take care of. Out of that, we can take care within the next 30 days 1,750. So that leaves, we have 250 to take care of. Okay, and there is another disposal of 1,000 later. There's no acquisition. So that balance 250 will adjust against the 104 holding. The 250 of the 2,000 shares, okay, so remember the 104 holding has only 2.9 left. So we take 0.25 and adjust it against the 2.9. Okay, so then what remains is 2.65. In the 104 holding, we have only 2.65 left. So that's your adjustment here. And then the last disposal that's happening is on 17th October. He has sold 1,000 shares. So nothing bought on that date, so nothing can be done there. Nothing bought in the next 30 days, so no adjustment from there. So you fall back on the share pool. And in the share pool, remember, you have only 2,650 left. So the 1,000 shares you sold will be adjusted against the 2.65 in the share pool, and so then what remains is 2.65 minus, so 1.65 will remain in the share pool. Is this clear? This is how you adjust. So you have to remember all these rules. So this is not given in the tax tables. So you have to remember the rules for allocating the pro rata cost of acquisition for acquired shares against the the gross GDP of shares which you sell. So you have to first focus on the sale and then apply these rules and then find out what the cost allocation will be. And in an actual exam, you'll see, this is the 104 holding. You can read this later on. So I think we have one more example here in this. Yeah, we got one more example here in this, which is, so here you see identification rules. Okay, example, same thing. Okay, what is this person who bought all these shares? What has he sold? Okay, he sold only one here, only one sale, 3.5. So he sold 3.5 shares at 36. So we have to find out, did he buy anything on this date? No, there's nothing bought on this date. Okay, did he buy anything in the next 30 days? Yes. So this is falling in the next 30 days. He bought 800 in the next 30 days. So what we can do is we can take out, we need to find 3,500 shares because he has sold 3.5. So we need to find purchases of 3.5 against which we can adjust the cost. So, but we can only find 800 by applying the second rule. So this goes down to 2.7. Let's see the working here. Okay. So you start with what he sold, and then you start trying to, so share bought on the same day, there was nothing bought. Now, bought in the next 30 days, yeah, he bought 800. So the amount to be adjusted, he bought 800 for what price? Let's go back here. He bought 800 for 6.4, okay? So against the GDP of 36, we can already apply 6.4 as an adjustment, and 0.8 is as an adjustment in the quantity. So now we have to find the remaining shares that are remaining here is 3.5 minus 800, which is 2.7. So you have 2.7 to deal with, right? Now, how are you going to find out the disposal? Now, this is where you see a further development of the rule, which now takes into account, in the first example that we looked at, we only considered the number of shares to be adjusted. We were not looking at the value of those shares. Now here, if you get a problem, you'll get a problem which is more complicated, like this kind of problem, where they're giving you the value of the shares as well. So you have to figure out, it's quite logical, you're going to use the same kind of, in this case, you're going to use a slightly different kind of logic, which is, you are going to use a proportion of the share pool, which is, you're going to use, how many shares are you selling and how many shares are in the share pool. And so you're using a slightly different logic from the part disposal, although this is also a type of part disposal that is happening. But anyway, so here you've got the problem. You've taken care of this much of the cost of acquisition, and you've taken care of this many shares. You still need to take care of 2.7 shares. So that has to come out of the share pool. These are the transactions given in the previous slide. So total number of shares left in the 104 holding, 7.3 at 30.25, right? So how many shares do you have to adjust? You need to adjust 2.7. And how many shares do you have? 7.3. So what do? You take 2.7 divided by 7.3, okay? You take 2.7 divided by 7.3, that gives you a percentage, right? So this is the fraction of the share pool that needs to be adjusted, or whose cost of acquisition needs to be allocated to the disposal proceeds, or the GDP. So what is that fraction? 2.7 divided by 7.3, then times, what is the value of the pool? 30.25. So it's quite straightforward also in a way, which is, although we are not doing what we did in the case of partial sales of land plots, but here we get this number, which is the pro rata value of that block of shares that we need, 2.7. That turns out to be 11,188. So your total cost of acquisition will be this 11,188 plus the one that you got from the second rule, which is bought in the next 30 days. And so these two together will give you a cost of acquisition. So you take this 36 minus this will give you 18.4. And then you have to make a note of how many shares are left in the pool. You had 7.3 and you took out 2.7. So what you are left with is 4.6. And you took out a value of 11,188, which means that the value left is basically 30.25 minus 11.2. That gives you 19.1. So that's the transaction. So this is so you have to be familiar with this kind of transaction. Okay, you are going to get these kind of complicated situations where now bonus issues and rights issues. So you got to know about what are these things. Well, have you heard of the expression bonus shares? Do you know this expression called bonus shares? Yes or no? Bonus shares are what you get for free. Okay, so existing shareholders get bonus shares for free. and so you just include them in the share pool at the zero cost. Okay, and then you have rights issues, which are new shares again given to the shareholders. The rights are given to existing shareholders. They're given a chance to buy the shares at a discounted price. This is for the privilege of being a shareholder in that company. Sometimes companies will do a rights issue. And the bonus issue is free. So you have to remember the rights issue will be included at the actual cost of acquisition for the shareholder, and bonus issues will be included at the at zero cost because they don't cost anything, right? Right. Let's go to the next. Let's look at an example. Okay, bonus issues. Now here you have to be, you have to learn the language of bonus issues and rights issues. The language that is used is, look at the language here. So he bought some shares, okay, and this here the company makes a 1-for-4 bonus issue. So what does he have? Look at the transactions that Will made in the shares. He made all these transactions, so many shares, this much cost, and so on and so forth, and he did these. So he's got this entire share pool. Then, so he does these transactions till October. The last transaction is October 2012. Then in January 2018, the company makes a 1-for-4 bonus issue. So you have to watch out for this language. You need to be able to interpret this language, okay? What does 1-for-4 bonus issue mean? 1-for-4 bonus issue means that for every 4 shares that you hold, you will get 1 bonus share. Okay, this is the language, so make sure you understand how to interpret the language, okay? So it is like, it's like what you get in the shop, in the McDonald's, like buy one, get one free, so it's 1 for 1, right? Here it's 1 for 4. So for every 4 shares you hold, you get 1, okay? So you figure out how many shares you hold, you divide by 4, and then you figure out, you get to know how many bonus shares you're getting. So 1-for-4 bonus issue, let's find out how many shares he has. So well, he's got 900 shares so far, okay? So 900 divided by 4 is basically 225. So you will get 225 bonus shares. So when this happens, Will gets 225 bonus shares. So his total number of shares will now be 900 plus 225. Now if you go, and then he sells 450 for, later on he sells 450 for £4. Yeah, 400 pence. Okay, let's look at this. Where is this example done? Okay, so let's look at this example, okay? So you see how to do these transactions. So we have a total of 900 shares in the pool at this value. Then you get 225 bonus shares at zero cost. Cost is 0, okay? So you end up with so many shares at a cost of 1.6. Now you make a sale, okay? So you sell 450 shares, and I think the value is 640. Yeah, use 450 shares at £4 per share. That becomes 640. Okay. No, that becomes 1600 in this case. So let's look at his disposal proceeds. Okay. Let's look at the disposal proceeds for this. Let's do the disposal proceeds for slide 40. We don't have anything for slide 40. Do we have anything working for slide 40? We don't have a working for slide 40. We can do this slide 40 working here. Okay. We can do this here for. Okay. So what does he do? Slide 40. Let's look at. All right. So what does he do? Let's look at the information here. So he has 900 shares which are worth 1600 that we have. So 900 shares is at 1600, and we have 900 at 1600, and then he will sell 450 shares for four. Okay, unfortunately we are a little bit behind the other section. Okay, and since we have a test today, we'll let you go early, and I'll quickly do the attendance. So we are stopping at, actually we are stopping, we can say, at the beginning of slide 39. So let me just make a note of that quickly. And we are stopping, so we are a little bit behind the other section. So in week 6, topic 7, so we are at the beginning of slide 39. Make a note of this. Start of slide 39, because we have to, okay, I don't know why it took a longer time today, but anyway, okay, all right, let's look at, let's stop the recording here.